Reflecting on the year 2023, we can clearly see the rise of systematic investment plans, SIPs, as a major trend. These convenient, flexible, and cost-effective tools have continued to gain traction among investors, contributing significantly to the growth of mutual fund investments over the year. In the past, individuals often felt overwhelmed by the prospect of investing large sums of money at once. But with SIPs, they can now start investing with smaller, manageable amounts, gradually building their wealth over time. This approach has resonated with investors, leading to a surge in SIP inflows. In fact, 2023 has been a remarkable year for SIPs. Despite starting the year with inflows of 13,500 crore rupees, we witnessed a significant jump to 17,073 crore rupees per month by November. This growth in SIPs has been a driving force in taking the industry's assets under management to a staggering 49 trillion rupees. It's not just about the numbers, though. The rise of SIPs also indicates a shift in investor mindset. More and more people are recognizing the benefits of regular, disciplined investing. They understand that it's not about timing the market, but rather about time in the market. And SIPs provide the perfect vehicle for this long-term, steady approach to investing. Furthermore, SIPs have proven to be resilient in the face of market volatility. Even during periods of economic uncertainty, investors have continued to maintain their SIPs, demonstrating their faith in this investment strategy. This resilience has further fueled the growth of mutual fund investments in 2023. In conclusion, the rise of SIPs has been a key trend in the mutual fund industry this year. By enabling regular, disciplined investing, SIPs have made wealth creation accessible to a wider audience. They have also proven to be a reliable tool in the face of market volatility. SIPs have indeed proven to be a game changer for the mutual fund industry in 2023. Another key trend in 2023 was the impressive inflows into equity and debt funds. The rising equity markets proved to be a magnet for investors, with small and mid-cap funds garnering substantial attention. These funds received net inflows of 37,178 crore and 21,520 crore respectively. Now let's talk about sector and thematic funds. Categories such as healthcare, consumer, and IT were quite a hit among investors. In fact, 29 new funds were launched in these sectors in 2023, pulling in an impressive 11,220 crore. Whether it was the allure of the booming equity markets or the promising sector-specific funds, investors flocked to these opportunities, pumping in substantial amounts. Equity markets and sector-specific funds have clearly drawn significant investor interest in 2023. SEBI's extended deadline for completing nominations is another important development to note. The regulatory authority has moved the cutoff to the last day of the year, December 31st, 2023. This extension underscores the significance of investors taking action, either to nominate a beneficiary or to consciously choose not to. So why is this so critical? Well, failing to adhere to this directive could lead to a sticky situation where your withdrawals could be temporarily frozen until you complete the nomination process. Now don't panic just yet. Your existing systematic investment plans and investments will continue to operate without disruption. But to ensure uninterrupted access to your funds, it's best to comply before the deadline. Remember, investors, it's vital to either nominate someone or explicitly opt out. Don't let this administrative detail become an obstacle in your investment journey. Changes in debt fund taxation was a major shakeup in 2023. From the 1st of April, capital gains on redemption of debt funds purchased on or after this date were taxed at the investor's income tax slab rate. This was a departure from the flat rate previously applied, and it had the potential to increase the tax liability for investors in higher tax brackets. Moreover, the long-term capital gains tax benefits and indexation benefits, which investors had enjoyed for years, were abolished for specific funds. This change impacted not just debt funds, but also gold ETFs and other financial instruments. But it wasn't all gloomy. The Finance Act of 2023 offered a glimmer of relief by grandfathering gains on investments made until the 31st of March, 2023. This meant that investors were not liable to pay the new higher tax rate on gains from these investments. In essence, these changes brought about a significant shift in how debt funds and other financial instruments are taxed. It has become even more important for investors to understand these changes and their implications. The evolving landscape of debt fund taxation necessitates staying updated and informed. These changes underscore the importance of staying informed about the evolving financial landscape. The mutual fund industry saw some fresh faces in 2023. 3 new fund houses made their debut, including Bajaj Finserv Asset Management, Helios Mutual Fund, and Zerodha Fund House. Each brought a unique strategy to the table. Helios and Bajaj Finserv are primed to launch actively managed funds, whereas Zerodha is taking a more passive approach. The diversity of these strategies ensures that investors have a wider array of options to consider when building their portfolios. But the landscape continues to evolve. As we look towards 2024, more fund houses are set to join the fray. Old Bridge Capital Management and Unify Capital PVD Limited are among those in the pipeline, waiting for regulatory approval. And these newcomers could bring fresh investment opportunities, giving you even more choices for your investment journey. So keep an eye out for these new players, as they could bring fresh investment opportunities. As we step into 2024, there are several key trends to watch out for. The growth of systematic investment plans is set to continue, fueled by financial stability concerns. Equity markets, particularly mid and small cap segments, are predicted to maintain momentum. Remember, the nomination deadline is unlikely to be extended, so act promptly. Changes in debt fund taxation highlight the need to stay informed. Additionally, keep an eye on new fund houses entering the market. Here's to a successful and prosperous 2024. Happy investing!